If you're selling a house in California, you're probably wondering exactly how much tax you'll owe.
Here's the good news. California does not have one single separate home sale tax.
Instead, selling a home can trigger up to 3 different money items you need to understand. The key thing to know is that 2 of these 3 can be reduced or even eliminated entirely. Let's start with the first one, the documentary transfer tax, which is the closest thing to a true sale tax. The statewide county rate is modest at 55 cents per $500 of value. This is charged on the price minus any liens still remaining on the property, and the county recorder collects it when the deed is recorded. The catch is that many cities, especially charter cities, add their own city transfer tax on top. For example, Berkeley property owners pay a combined $16.10 per thousand. So on a $900,000 home, the base state and county transfer tax is only about $990. But in a high-tax city, the total transfer tax could be thousands more. So always check the exact city and county. Now to the second item, income tax on your capital gain.
California has no special capital gains rate, so it taxes your home sale gain as ordinary income.
Those rates currently run from 1% up to 12.3%. There's also an extra 1% mental health services surcharge on taxable income above $1 million, pushing the top rate to 13.3%.
Here's where big savings come in. The federal Section 121 exclusion also applies for California.
If the home was your principal residence for at least 2 of the last 5 years, you can exclude up to $250,000 of gain if single. Married couples filing jointly can exclude up to $500,000 of gain. Only gain above the exclusion, or gain on a rental or second home with no exclusion, gets taxed at your ordinary California rate. Remember, the state tax is separate from federal capital gains tax, which runs 0, 15, or 20%. The third item is real estate withholding on Form 593, which is a prepayment, not an extra tax. When California real property is sold, escrow generally must send money to the state as an advance on the seller's income tax. The standard withholding is 3 1/3% of the total sales price. Alternatively, the seller can elect to compute withholding on the actual gain using the maximum rate, which often withholds less. Crucially, withholding is not required when the sales price is $100,000 or less, or when the property was your principal residence. Whatever is withheld is credited on your California return, and any over-withholding is refunded. So it's just a timing mechanism. Let's put it together with an example. A married couple sells their longtime home for $900,000 with a $300,000 basis. Because they qualify for the $500,000 joint exclusion, only $100,000 of gain is taxable. Their base transfer tax is about $990, and their income tax at roughly 9.3% is about $9,300. They could face about $29,970 in withholding, but the principal residence exemption lets them avoid it entirely. Bottom line, for most owner-occupants, the only unavoidable state charge is the small transfer tax, while the exclusion often wipes out the income tax and withholding. This video is educational information only and not financial or tax advice, so check your specific city and county and consult a professional for your situation.